Hello everyone and welcome back to the channel. If you are learning accounting or bookkeeping, you probably might have heard about the journal. We also discussed about journal entries a couple of videos ago about writing journal entries in the journal. Okay, journal entries basically give you details of each and every transactions on a day-to-day basis. But how do we easily find out how much cash we actually have on the end of the day or end of the month, or how much a specific customer owes us by today, or at particular period, how much does a customer owe us, or how much do we owe to a supplier? So if we have to find out, okay, that's where the ledger comes in. Okay, now today we are unlocking the secrets of the ledger, often called the king of books in accounting. We'll cover what it is, why it is crucial, how to use it, including, say, we'll discuss about posting and balancing and how it is organized. Okay, now let's get started. What is a ledger? Think of it as a main filing cabinet on your accounting system, while the journal is like a daily diary of every transaction. The ledger takes that information and sorts it into specific folders or accounts. Now there is an folder, or there is an account for cash, one for sales, one for, say, rent expenses, one for salaries, there could be one for a customer, one for supplier, and so on. Okay, it's the principal book where we classify and summarize everything. Okay, now where does ledger basically fit in the bookkeeping flow? Let's understanding the accounting flow chart to understand why ledger is very important and what is the flow chart of the complete accounting process. First, we have a transaction which is proved by source document like a bill. Okay, second, we record this transaction chronologically in the journal, which we have already discussed uh, in details in our past video, writing the journal entries. Third, you post that information from the journal to the specific accounts in the ledger. This is where we are here. Okay, now later, information from the ledger, from these ledgers, is used to create a trial balance, which we'll discuss in our later videos, and ultimately the financial statements. Okay, the last aim, the main goal of accountancy is to create financial statements. Okay, that also we'll discuss in a later video. Right now we are in the third stage in our accounting flow chart. Okay, now why is ledger so important? Well, the journal alone generally doesn't easily tell you the balance of a specific thing. If you look at the journal, they are only journal entries. You can find out, okay, what happened in one transaction. Okay, but if you want to figure out your bank balance just by looking through that journal or through a diary of every single deposit and a withdrawal, all are mixed together in that journal, it is very difficult to find out the balance. Okay, now the ledger basically groups all transactions for one account, say like cash, all in one place, or for sales, they all make it in one place. Okay, so that way it makes it super easy to see the activity and calculate the file and balance. Okay, this is essential for control and reporting. Okay, now let's look at the format of a ledger account. It basically looks like a big T. Okay, this is a ledger account. This is the T format account. Okay, now the left side is a debit side, the right side is a credit side. This is the T format. Left side will be debit side, right side will be credit side. Okay, now you always remember the debit or credit rules. Yes, yeah. Assets and expenses usually increase in the debit side. Okay, assets and expenses, usually whenever assets increase or expenses increase, they are on the debit side. Liabilities, equities and revenues usually increase the credit side. Those are the rules. We already did a video on that part, right? So liabilities, equities, revenues usually increase on the credit side. Now each side has a column for date, particulars, journal folio. Okay, where in journal folio we basically link back to the page number of journal, and amount. Okay, let's just understand that the standard format looks like a large T. Left side debit, right side credit, right? Now columns on each side: date, date of the transaction; particulars, particulars, basically what does particulars do? Yes, name of the other account involved in the journal entry. JF, journal folio, it's the page number of the journal where the original entry is recorded, just to check for the cross reference. The amount, that is the monetary value of the transaction, right? If you want, just look at it. Perfect, no problem. Now how does information get from the journal to the ledger? Okay, how do we write postings? How do we basically post entries, journal entries to a ledger? That is called posting. Moving data from journal to ledger is called posting. Okay, it is called ledger posting as well. It's just a transfer process. The rules are very simple. If an account is debited in the journal entry, you record the details in the debit side. Okay, I'll explain that with example, but let's just understand the rule here. If the account is debited in the journal, you record the details on the debit side of that account in the ledger. If the account is credited in the journal entry, the posting is made on the credit side of that specific account on the ledger. On the particular columns, you basically write the name of the opposite contra from the journal entry. Let's actually understand this by example. Now let's take a transaction. There was on January 5th a cash sale was made for 10,000. In the journal book, what will you write? What is the journal entry for cash sales made for 10,000? Cash account debtor to sales account. Very good. Now cash account debtor to sales account 10,000. That will be the journal entry. Now how will this posting go? On the debit side. Now let us check on the posting. In the cash account, the ledger, this is the debit side, left side, right side is credit side. Okay. Yeah. Now on January 5th, the posting, the journal entry was cash account debit to sales account. So in the cash account, you'll write to sales 10,000. Perfect. You understood the rule? If an account is debited in the journal entry, the posting is made in the debit side of that specific account. And in the particular column, you write. Very good, very good. Now, in the cash account is debited. In the cash account ledger, you write to sales account. Okay, you write to sales account. Understood? You write it debit. Okay, because it is debit here, you write on the debit side. Okay, if the account is debited in the journal entry, the posting is also made in the debit side. By what name? By what name? By the opposite name, by sales name. Okay, understood? Date January 5th, cash account debited, that is the debit entry, to sales account. The particular has to be to sales account, the credit account. Okay, similarly in the sales account, What we write? On the credit side, we write buy cash. Now the rule of to and buy, that is in traditional method. Why do we write to and buy? Okay, to understand. Now cash account to sales account. Okay, on the debit side, you always write to. On the credit side, you always write buy. Always remember that. That's also a traditional rule. Okay, now again, cash account to sales account. In the ledger of cash account, you will write to sales account, amount 10,000. In the sales account, the opposite entry, by cash. That is credited, right? By cash, 10,000. This is how you basically write accounts in the ledger. How do you transfer from journal book to ledger? This is how you transfer journal entries to ledger. Okay, now let's try to understand what is balancing. Now what happens is, in general ledger, in ledger accounts, you write all the transactions, but on every month end or quarter end or week end, you need to know how much is the balance, what are the total balances amount. Okay, for example, on January 5th there was a sale, on January 6th probably I purchased something, on January 7th again sale, but you know, this is only show me debit and credit amounts there, but you know, we need to balance it. So end of the period, we need to figure out the net result for each account. That is called balancing. Okay, now let us understand how a balancing is done. The first is, you total the amount of debit side, then total the amount of credit side, find the difference. The difference is the balance. Example, cash account. We already made, we had only one entry. We didn't want to confuse, so we only added one entry there. In debit side, the total is 10,000. In credit side, there was no entry. The total was only 0. Okay. So what we did to balance it, to balance the cash account, we added by balance carried forward as 10,000, or balance carried forward or carried down. It can be called as carried down or carried forward. Okay. Now the total cash balance on the debit side total is 10,000. On credit side there was 0 balance. Okay. So the difference was 10. So to make it balance, to make it equal, what we did, we added an entry by balance carried forward 10,000. That is how this is balanced. Okay. Now why do we balance it? To know the balances for the next period. Okay, for the next period, if you look, January 5th sales 10,000, but when did we close it? On January 31st, the balance carried forward was 10,000, so that we can open a new ledger for the next month, for the next transaction period. So on February 1st, when we want to open a next ledger account, a cash account, we carry forward this balance. Okay, you see here on February 1st. Okay, now how do we carry forward it? How do we carry it forward? On last month account, the credit balance, the debit balance was more. So it was by balance carried forward. Now, after finding the balancing carried down or carried forward, we basically write it to the opposite side. The balance is brought down to the opposite side below the totals to start the next accounting period. Right? Here the balance carried forward was on the credit side. So when opening the same cash account for next accounting period, we write it on the opposite side to balance brought forward. Okay. Same thing, if sales account is closed, then we would have to write it on the credit side. So when it is closed on the credit side, we write it, we open it on the debit side. Opposite side we write it. Okay. Now that basically represents the opening balance for the new period. So the opening balance of cash account is 10,000, right? That is how it will come. Now, okay, how do we understand a debit balance or a credit balance? If the debit side was originally larger, okay, or the balance is brought on appears on the debit side, it represents as the debit balance. If credit side was larger, then it is called credit balance. For example, in the cash account, the credit side was larger. So the difference was 10,000. When we totaled it, debit side was 10,000 more, credit side was 10,000 less. Right? It was 10,000 less. That is the reason we wrote balance carried forward. So because credit side was less, it is called debit balance. So the cash account has a debit balance of 10,000. That is how it is called. That is the reason when we carry forward for the new accounting period, it will show as debit. Okay. And understand this. All assets and expenses will typically represent debit balance. All liabilities, all equities and revenues will always have credit balance. The example here is the cash account. Cash account will have a debit balance. Why is this having debit balance? It is an asset because the debit balance was more. When we created the ledger, posted all our postings, the debit balance was more. So when the debit balance is more, you write in very good, fantastic. It will be debit account. Okay. Now, let's try to understand what happens in big businesses. Okay. In big businesses, having one massive ledger book is impracticable. So they often use subdivision of ledger. They divide the ledgers into different parts. They subdivide the ledgers. They split it into, say, sales ledger, purchase ledger, or general ledger. All the rest like assets, liabilities, capital, expense. These are all general ledger. They all fall under general ledger. Okay. Now, why do they do it? Why do they do it? Yes, to solve the problem, because single ledger book becomes very huge and difficult to manage. Okay. In our next video, we will basically discuss about different types of books. Okay. At that time, you'll understand more about why we divide the ledger. Okay. There is sales ledger, there is purchase ledger. We have a different cash book, bank book. In our next video, we'll discuss on that. Okay. So it is basically made so that things are more manageable, and it will also allow different people to work on different sections. For sales department, there will be different people working. For purchase department, there will be different people working. So this helps that. Okay. Now, there you have it basically. Now the ledger is basically the principal book which classifies transactions into different accounts. It takes the chronological data from the journal, classifies it into accounts, and allows us to find balances easily through posting and balancing. Right? And also from here, we can take it forward to all financial reporting. Okay. Understanding the ledger is basically the fundamental to understanding accounting. Okay. This is what we basically do in ledger entry. We follow the journal in a format. We format it in T account. we post the journal entries into ledger, then we balance it to create a trial balance, okay, which again we'll discuss in the later videos. From the trial balance, again we'll create our financial statements. Okay, now if you found this video helpful, please give it a thumbs up, subscribe for more, and hit that notification bell. Thanks for watching and happy accounting.